One of the big unknowns for the business community is just what impact today's rate cut will have on the dollar. When the announcement was made, the Aussie lost nearly 1 US cent, which means in the last few weeks it shed 5 US cents. We thought that was a good reason to go back to our economic experts, who at the start of the year were confident the dollar would stay high throughout 2012, with only Morgan Stanley's Jared Minnick tipping it to fall below parity by year's end.
Today's 50 basis point rate cut by the RBA doesn't have a huge impact on my currency forecast, partly because I was expecting the cash rate to be down towards 3% at the end of this year, and also because in the second half of the year the main influence I'm looking to weaken the currency is actually commodity prices coming off rather than further dramatic reductions in short rates here. So 90 cents still looks okay.
Well, interest rates are certainly important, but the fact is, even with rate cuts, that differential between Australian interest rates and the rest of the world is still very high. It may be smaller, but it's still relatively large, and that's going to be a powerful support for the Aussie dollar.
Well, I'm probably going to lower that forecast to $1.05. I think if market sentiment shows that monetary policy is going to continue to ease, then that will put downward pressure on the dollar. But the fundamental story, I think, still one for the dollar to be above parity. The emerging markets, China and India, Brazil, still means that the Australian currency is going to be a strong one globally.
Well, after some near-term weakness, slower growth in the Australian economy, RBA rate cuts, which might see the Australian dollar drifting down towards parity, we still look for 105 cents for the Australian dollar at the end of the year. We think the world will be looking a bit better, and we think Australia will have steadied. So we still have that same forecast.
You're in a world where you'll probably cut some more. In the short term, that will probably hurt the currency, but fundamentally, I think we'd leave the currency forecast at around 101. It's more driven by what's happening to commodity prices and what's happening to China than it is about what's happening to interest rates.
4 months on, our experts are not seeing much relief for the business from the high dollar. Only 2 have changed their forecasts, with the University of New South Wales' Tim Harcourt lowering his to $1.05, which the Commonwealth Bank's Michael Blythe has lifted his prediction by a whopping 9 cents to $1.09.